starting?
Yeah.
Welcome to another episode of Market Overdrive. I am your host, residential real estate broker Carla Mina with Coldwell Banker. And today with me, as always, every Thursday, my co-host. How are you, Nick?
I don't know.
I'm good.
It's an interesting... Oh, look.
Wait, we're starting with a different Nick.
This is Baby Nick.
Lord.
Baby Nick
Nick.
Jr.
It's a birthday party in the house. Our Nick, who is eternally going to stay alive, is celebrating, 25, 26?
No comment. No comment. Vampires never give
Happy
their age.
birthday, Nick. So I figure, we all try to be Nick today. It's the Nick show.
Uh-oh.
The next show.
I don't want everybody to be Nick. It takes the fun out of life.
Did you hear that? He wants us to be us. So welcome. It's a full house in the studio with us. And we have a very special guest aside from our Mimi, who's here also every month. Nick's mom.
This is the worst date ever.
Hi, Lydia. Everybody has heard about Lydia, about how many hours you work, about how many deals you put together, how amazing you are, about how, you're a Remax top producer, and how you can cook.
Thank you, Carla.
But today you brought us a very special treat. Show us what your mom made for you.
Oh, hold up. It's
That's
actually one of my favorite coffee cakes.
Look
That's
at
the
that.
best.
So
That's the
can you
best
say
coffee
it
cake.
in your face, Nick? I can bake and cook. See? Realtors can do it
doesn't
better.
bake that. She prepares that. It doesn't even go in an oven. It's like made a special way.
Just like a man to
Just like a
go
man.
ahead
It
and
doesn't
downplay
matter.
everything a woman
That
does.
she had to go buy the ingredients, go to
Yes.
a closing,
And
put
put it
together a
together.
huge deal, land this pocket listing. Congrats on your huge deal. I heard
Thank
about
you.
it.
Thank you.
But today's show is going to be amazing because it's towards the end of the year and it's the holidays that are upon us. And I know a lot of you are thinking of selling or buying, but today's show is more about 5 reasons why you should refinance your home. So it's all about financing and how we come into play to help you. And of course, to elevate your real estate IQ, I always lean on my mod squad. So Mimi, why don't you go ahead and start with the questions?
So today's all about the lenders, huh?
Finally.
It's a birthday. Apparently a birthday celebration at work. I don't know why I have to do the most work today. I like to sit in the cruise control seat and not do much.
All right. So what is the purpose of refinancing, guys?
Whoa!
Oh, there we have it.
I don't even have my notes.
No, you don't need notes. How long have you been doing this? Come on.
We got a script that we're gonna follow.
yeah.
In
No.
order. We're gonna go in order. Top 5 reasons why you should be refinancing.
there's really probably, on a day-to-day basis, I think that we run through about 10 typical reasons people refinance for the most part, but 6 through 10 come very far and a few apart. 1 through 5 are the most common reasons that people tend to refinance. But the one thing that, before we get into the top 5 most common forms of refinancing, the one thing that we try to remember when people are refinancing, more times than none, it's a financial instrument. They're either trying to save money, get money, or whatever the case is. There's dollars involved. Unfortunately, in some cases, it's not a financial instrument. It's a strategic move to remove somebody from the existing mortgage, or there's something more involved that's more personal. So those don't come very often, but they happen. So we'll get into all those in a little bit. But when you're going to go looking for this stuff, if you're going to be curious as to our advice, whether or not to do certain types of refinances or take advantage of a mortgage product of any sort, you want to go to our website. Actually, you want to go to our YouTube page, which is Market Overdrive. It's at YouTube. Also, obviously, Facebook/Market Overdrive. And you will always be able to hear all of our shows at the WGN Radio podcast. So subscribe to that bad boy and you'll find us there. So hopefully we come up with some good information.
So we're gonna go. We're gonna start with.
Are you guys not
number
gonna
5?
We're jumping right into
We're
it?
gonna start right.
Yeah,
into
We're
it.
jumping right into
Are you
it.
just
for it.
gonna,
Yeah, I mean, we're
you
already
just gonna sit there today?
Today, yeah.
Yeah,
okay.
we're just
For
sitting here
surprise.
going to look pretty and sing happy birthday.
Always look pretty.
Okay.
All right, so let's get all the happy birthdays out of the way. To early happy birthday.
It's not just
for
my birthday.
Nick.
Everyone made,
Carla's birthday.
Carly's
follows.
birthday is
Should
the
I
day
show
after mine.
my cake?
We're gonna show
Show your
everybody.
cake.
Can you show the cake, please? This is the cake.
Mom, don't look at this. It's just really weird. Can you see
No,
it?
it's perfect.
It's
It's
perfect.
Rocco on a unicorn. That makes all the sense in the
I
world.
love it.
Come on.
You just dive right into
It's the
eating
thought
that. Huh?
that counts, right?
so weird, really.
Weird.
Okay, so
There's
they always
pictures of me
make
as a
fun of
baby
me. because I say life is like,
Rainbows and
no, I
everything's
don't
perfect.
say that. Nick's always making fun of me because he thinks that everything.
I say that.
You say that. You guys are always making fun of me because life is, right? Rainbows and unicorns, they're just weird. Life is always awesome.
So let's start with number 5, right?
Let's jump right into it. I mean, number 5, this is the one that I see more, surprisingly, I mentioned earlier, the one that I see come up more often that really doesn't have much financial implications is, or I should say directly financial implications to the mortgage itself, is people come in to refinance because they, for some reason, maybe they bought the home with a co-borrower or there's someone else on the mortgage note. So it's not, in some cases, they've even done it where the rate goes up, believe it or not, or when they're not reducing their payment, which is not normal. But they really need to get that person off the loan for whatever reason. So typically, divorces. Divorces are a very common refinance instrument,
Well, typically we have, you have borrowers that will take on a family member as a co-applicant or a co-borrower to a loan. So the idea is it helps borrowers to qualify a lot easier when they're buying a property. But as the years go by, that individual might want to buy their own property on their own. So another reason to remove somebody from the mortgage would be to refinance to the individual to come off that mortgage. Just as Nick touched, divorce is also a common reason why somebody's going to come off the mortgage. But that's, honestly, I think that's a little extreme. I think most people go into a mortgage to help them qualify as a secondary borrower, and then they come off the loan later because they themselves want to buy their own property or investment, whatever.
Well, that's why you see it in divorce, though. Divorce is a situation where, they want to move on and buy something else. They don't want to be essentially still holding on to a previous loan, which could complicate their process. So divorces are, and some people just, look, sometimes divorces are bitter and they get ugly and they don't trust one another anymore and they don't trust to be on a loan. They think that the other person might just stop making mortgage payments just to mess with the other person's life, so.
Well, it's good to know that you have that option, right? So when you're going through a hardship such as a divorce, you want to go ahead and have, if one of the spouses wants to maintain the asset and wants to keep the property and have it as a primary residence, you can always refinance and get that second spouse out of the mortgage, which is very important. You just got to make sure that the person who's keeping the property qualifies for the property alone. So if you've owned the property for a very long time and you're going through a separation, you're going through a divorce, what is the first step, right? Because what if there's not enough equity in that property? Or what if I don't qualify for it alone? Like, what would you advise me to do in that type of scenario?
Typically, those are court orders by the judge, and the judge is going to specify X amount of time to pass. Let's say the judge gives a timeline of 5 to 7 years. Within that 5 to 7 years, hopefully there'll be enough equity in the property to be able to sell and get that individual out. Or
if you go to refinance, look, if you have to go to refinance it, no lender cares about your divorce, unfortunately. Dollars are dollars. And so,
right, so you're going to care whether they can qualify
guarantee
for
that
it.
they could refinance you just because you need it done.
Right.
Yeah,
so
but I think she was saying,
can't
what
make
if they
that
can't
assumption. Well, they can't, then you're still
qualify?
unfortunately married some way, somehow.
Yeah.
So would you recommend that they get an appraisal done on the property first to see if there's enough equity or is this, I'm complicating it because it doesn't matter whether there's equity in the property or not, you could still refinance as long as you can afford the payment on your own.
Yeah, there's always going to be an appraisal done on the property.
The house can't be underwater. It's going to be really hard to refinance it.
So if you're underwater and you're going through a hardship such as a divorce, not hardship, but circumstance, you're able to refinance and get that spouse off the mortgage.
At that point, Graco said, he mentioned short sales. If you're underwater or you're at the cusp of like 100% LTV and you just can't, there's no refinancing programs for you individually, then yeah, you're going to have to deal with possibly short selling it.
Okay. What about a scenario where somebody just bought the property, right? And maybe a year later they decided that I didn't buy it in a location that I'm really happy with, or maybe I bought in a condo and like we had, George come in the studio and say he didn't like the president of the association, so now he's selling. What happens when you just bought a property? Is there like any penalties with refinancing? After how long do you recommend that people wait before they can refinance?
I mean, you could refinance the next day.
Yeah.
There's most loans there are
no prepayment penalties.
There's no prepayment penalties. In some states, it's very specific. There's no prepayment penalties allowed. Depending on which state you're in, check your state. But more importantly, what kind of loan did you do? well over 90% of the loans being done today are Fannie Mae or Freddie Mac owned loans, or they're FHA or government VA loans. So that's a big portion, the lion's share of all loans being done. So those don't have prepayment penalties. However, again, check your state, check the lender that did the last loan, because if you did a subprime loan when you bought the house of some sort, those are a little bit more niche. They might have prepayment penalties. I would not recommend refinancing just to refinance if you're going to get hit with a big prepayment penalty. But for the most part, and today I haven't even seen a prepayment penalty on a payoff in years. So that's not a big worry. But you'll have lenders that'll tell you you can't refinance for the first 6 months. The reason they're telling you, in all honesty, is because it costs them money if that happens. You know, they'll tell you the 6-month window. But legally, you have your right to go and do it. I mean, I don't want to be the guy that kind of throws other lenders under the bus here, because it sucks for anybody, you know, in our trade to do a loan and then find out 2 months later you lost whatever revenue you generated because they went and refinanced elsewhere. But I guess that's on the person that did the loan, because you should have put them in a good enough rate that it wasn't refinanceable.
But with
You
that
know?
said, when you do refinance, there's a cost to it, right?
There's always going to be a cost to it, yeah.
There's always a cost.
So doing it the next month, and you might have paid all this money when you bought the house, then
Yeah.
refinancing, that is another
You know,
charge.
I can date back to like 2001, and even some cases in 2 and 3, where people bought a home. Let's take August of 2001. If you bought a house in August of 2001, you probably had a high 7% interest rate on a 30-year fix. 9/11 happened. The market kind of froze up. Everyone into a free fall. The economy was struggling. Rates just plummeted, and you know that 7.5 turned into like a 6. Well, those people that bought a house in August were literally calling us on November, in October to refinance. That wasn't anywhere near 6 months, but they had all the incentive in the world. Their rates fell over 1.5 points,
Right.
just going from 30-year fix to 30-year fix. So unfortunately, a lot of lenders did lose money with that plummeted interest rates, and that was happening more times than none during that era of a refi boom. But you are allowed to refinance the next day. I mean, there's no, you know.
There has to be a benefit, though. You can't just
Yeah, it
refinance
has
just
to make
because.
sense.
There's got to be a benefit.
Right.
It's something called a net tangible benefit that's required whenever you do refinance.
Did he just throw out a big word?
Big
Like
word.
what's
Threw out
happening
a
there?
big word.
Net.
Net
Big-
tangible
a big-
benefit
big-
is
But we
required
got-
when
And
you
what does
refinance.
that mean in layman's terms for people who don't know what that means? I
In
mean,
short,
we know what it means.
In short, there has to be a benefit. So example, like Nick just said, if you close at a 7% interest rate and the market the following month drops to like 6%, 5%, and you want to refinance immediately because the rates have dropped, that's a benefit. So
Right.
as long as there's a true benefit to the consumer, you can refinance at any given moment.
Yeah.
Like for example, in the case of an FHA loan product, if this is the only program that you qualify for, given debt to income ratios or maybe credit scores, and you're kind of tight on your numbers, you start with an FHA loan program and you want to get out of that program, you're able to refinance and get the PMI out. Right? It used to be that once you had 20% equity into your property, your PMI will drop off. It is now the case where you never drop off unless you refinance out of that program. Correct?
Right.
Yeah, that's number 4 on the list. I guess
Yep.
we can
you,
move
you
on.
can go
look
ahead
at
and
that.
get the number 4, man.
Getting rid of mortgage insurance, PMI, private mortgage insurance, whatever you want to call it.
that would be probably one of the best reasons to refinance.
Well, it's one of the top 5, that's
Yeah.
for sure. Yeah.
I can say this particular month, we've done quite a few clients who bought a home 14 months ago with an FHA loan program, and now they want to go into a conventional loan program, getting rid of that mortgage insurance. So, like Carla said, you get borrowers who particularly might want to go into an FHA loan program. Mortgage insurance is forced upon you. It never goes away with an FHA loan, unfortunately. But with a conventional loan, eventually,
And you,
go ahead.
sorry, I didn't mean to cut you off. You really have to, for those that are listening, refinancing to get rid of your mortgage insurance, generally that sounds very logical. That's a very good reason to actually go ahead and refinance to get rid of your mortgage insurance. However, if you've been sitting in your mortgage insurance for the last 7 years and there's maybe about 1.5 or 2 years left, you need to rethink the refinance. Because like Mimi
Why?
mentioned earlier, because there is costs in refinancing.
Okay.
And, I don't know what the rates are at. Do you have a 5? Can we beat 5? I mean, are we close or comparable in rates just to get rid of this mortgage insurance? As the mortgage insurance sits there longer, there's less of it left. You're
Right.
not in mortgage insurance forever on most loans now. There is one FHA loan that you are in mortgage insurance forever. But if you have a conventional loan and you've been sitting on it for 7, 8, 9 years, that thing's probably going to fall off anyway. So just because you have mortgage insurance, don't go running to refinance with less than a year left. You want to do it typically in the earlier part of the loan. So in the first year, that's where you really capitalize on getting rid of this liability that's happening every month of, let's say, $200 or $300 a month in mortgage insurance.
So I just got that question again. I'm sorry, Mimi. PMI is removed once you have 20% equity in the property, and that answer is not anymore, right? You can refinance at any time. There's no
Anytime.
prepayment penalties,
If
but
there's
it
equity
used to
there.
be
If there's
that
equity.
it would fall off, and then you didn't have to pay for it. But remember, with an FHA loan program, you're paying 1.5% upfront in the PMI, and PMI is just a mortgage insurance product that's going to protect the lender in case you default on the mortgage. So it doesn't necessarily protect. It's not a hazards product. It's going to protect you if the house burns or anything, or the property burns. It's just to protect the lender in case you default. But remember, it does not fall off once there's 20% equity in the home. The only way that you can get that payment out on a monthly basis or removed is if you refinance.
Now,
But it's
What?
not just
It's not?
FHA.
you said you
buyers.
have to have 80% loan to value, right?
Right, 80% loan to value. You can do different products now.
I'm not going to tell you what it is because I'm going to make you call us on this one. But we can get rid of it if you're, let's say, at 93% or 94% and you still have mortgage insurance and you go to refinance, the house doesn't appraise at 80% or less. There is a way that we can actually do that.
Wait, but you have to start with that program to begin with.
No.
So why? Wait,
No,
you're
I mean,
annoying.
you got to give everybody an incentive to actually just call us.
Well,
and do
here's
it.
the thing, though. I'm
Wait,
sure
just
there's
explain
people
it.
Call
who
iLoan.
don't know that they have.
Wait,
She's
go
like
into
the
your
robot
event.
over there.
Call Graco.
Wait,
I'm sure
Lydia,
there's
when we
people
go to events, right? We're at like a NAREP event, a YPN. iLoan's the best. Do your thing, Lydia. I'm like, Lydia, please.
Well,
you're
it starts
embarrassing us.
from the people work there. It starts from the logo. It starts from a customer service and the quality.
I love you,
It's
Lydia.
value.
Simple enough. It's value.
And
right?
who's the best? Who's the best looking kid in the world?
My son.
This kid, huh?
Who?
It's Nick. It's
Now
my
you
son.
know where he gets his ego, right? It's been years and years of like
Got built up.
Lydia-ness. We're gonna call it the Lydia. I'm sorry, Mimi. You were saying.
Good Lord.
So I'm sure there's people out there who don't know that they're paying MI, right?
Well, it's
should
pretty.
know.
You should know. I mean, you
Yeah.
have
I
a
mean, they
horrible
should, but
loan
I'm
officer
sure
if you
I've
don't
sat
know.
with people and they don't know what they're paying. They're just like somebody didn't present it to them well, and they're just paying it, right?
Yeah,
but I
you,
mean,
you do get your statement every month. I mean,
Those are the
maybe you didn't know getting into the loan. You're
Right.
right.
Officers.
But after like 3 or 4 statements, you probably have analyzed where your dollars go, and there'll be the principal and interest at the
you would
top.
think.
Yeah, I mean, there's the escrow payment, and then there's this little ugly
So
thing that
then
says mortgage insurance.
Maybe we should tell people how it is that they come into that PMI, right? If you have less than 20% down on any kind of property.
Yeah, very good.
Typically,
Yeah,
but I mean,
Typically.
if you don't put down 20%,
You're going to get
most
PMI.
lenders are going to offer you mortgage insurance
Right.
or tell you need to take mortgage insurance. This is the most typical way of doing a loan. To be honest with you, yeah, if you're buying a house and it's less than 20% down, you're going to see mortgage insurance. Now,
Right.
again, we do have a way to do that without mortgage insurance,
Whatever. Stop it.
but you're going to have to call us to find out.
So just to go ahead and like kind of, just, not dumb it down, but just break it down a little bit more. There's like basically 2 loan products, right? One where you're 20%. Remember, the lender's your business partner. They're going to put the balance of the money that you're not putting down out of your pocket in order for you to be able to buy that property. So it's either 20 or less than 20%. Anytime you're buying something with less than 20% out of your pocket for down payment, you are going to have to pay a premium. And that premium comes in the form of higher interest rates or in the form of this mortgage insurance premium. So our goal as realtors is to guide you through that process so that you're able to have a monthly payment that's comfortable for you, because you have to include all these different payments in your monthly budget. So when you're buying a condo, you got to add that assessments. When you're buying into a single family, you're always going to have, with the condo, you're going to have insurance, but it's going to be a little bit cheaper. It's more of a homeowners renters insurance kind of value, but a single family, you're going to pay for insurance, but then you're also going to have that mortgage insurance premium that's going to add up to your budget as well as the assessments.
So also our value as realtors, we reach out to our clients after a certain amount of time and let them know, hey, your property has increased in value and might be a good time to refinance.
Right.
Small disclaimer here, you're a little bit of a mortgage wizard yourself.
Right.
You're married to a very known mortgage rep.
Yeah.
He
And
is.
you're also,
She is.
you worked in the mortgage industry, so
Yes.
it's not like you're just speaking from a realtor standpoint. You know
Right. I know it all.
it all.
I know it
All
all.
right.
Which
Cool.
makes sense, right? When they're servicing your business or when Mimi's servicing your business, because she understands the whole concept of the financing, because she is working in tandem with her husband who does her loans. And I mean, you guys work together with iLoan loan as well in some of the deals. But
For sure.
but when you're working with your
Our
buyers,
second husband.
please
I'm the
don't
unofficial
claim
second
him.
husband.
God, I just vomited.
We get the leftovers that Nick Yassine doesn't want to do.
Vomit.
You know.
I'm just gonna stay here and be quiet today. We're fighting for the mic today. I'm not
No.
fighting because it's you talking all
Nick
the
gets
time.
the mic everywhere today. You know.
But Mimi, do you work with a lot of FHA buyers, or how does that work for you in your business plan?
I do work with a lot of FHA buyers who then become step-up buyers, but I mean, we always have to tell them about that. And if they don't have the 20% down, they always get the mortgage insurance. But then we keep in contact with them to let them know when it's time that their property is worth more and they can get out of that.
Well, what do we got here so far?
Wait, I have
We've got
another one. 1.75% upfront PMI, so that's that prepayment that you do upfront. FHA has a mortgage insurance for life only on 90% LTV or above for 30-year
correct.
mortgage.
That's the instance that I mentioned earlier. There's a certain FHA. If it's below 90, it does fall off. If it's above 90, it never falls off. You're going to have to refinance to get out of the mortgage insurance. On an FHA loan. On a conventional loan, you don't. It'll eventually will fall off. Now, where were we on that? Number 5, the most common reason was typically people want to remove somebody from the existing loan. You don't have to refinance to remove somebody off a title, by the way, folks. It's just to remove them off a loan liability.
But we really want them off of title.
Right. Well, but I'm saying if you own a house and you're the only one that took out a mortgage, but then you're getting divorced, and your wife was on the title with you, but she wasn't on the loan, you don't have to refinance the house to get rid of her off title. You can just do that with an attorney and deeds.
And
Right.
that's, of course,
It's only to get rid of somebody that's got a loan liability attached to them right now.
But what about the case of, like, say, the millennial, right? I can't afford at this time now because I'm a millennial.
Yeah.
Celebrating less than 30.
You're the only 70s millennial I've ever met.
Why do you have to be so mean all
I'm
the
sorry,
time?
80s. We share the same birthday, man.
I'm not as old as you, though.
You're one
so-
day younger than me.
No, I'm not.
You are one day younger than me.
Are you serious right now? I'm so much younger than you. Graco, tell him.
How did we get to millennials?
I know. Anyway.
Okay, anyway, so if I can't afford, because I don't have, a lot of income right now, maybe my mom or my dad signed for me on the loan, I want to refinance to get my parents out because, you know what? I just got a promotion. So would that be one of the
That would be
reasons?
an ideal reason to refinance and remove mom and dad from
So
that
mom
note.
and dad, if you're listening and you want to give your kids a chance, an opportunity to grow up and be responsible and obviously build some equity over time and, just own a zip code in Chicago, that's the right way to do it because eventually you are going to be taking out of that loan.
All right. Number 5, we said removing somebody from an existing loan. Typically, this is in divorces, but not necessarily always the case. Could be parents that are attached to you, best friends that you bought a place with, or a girlfriend, whatever the case was, and now you need to get that person off of the loan. That's one of the most typical reasons we see somebody trying to refinance. Number 4, Graco said, is to get rid of mortgage insurance. It's a very good strategical reason to refinance your house. Oh, boy, who's ringing?
Who's ringing?
Who's
We
ringing?
also have your daddy. Your dad.
I knew somehow he was going to mess something
Hi,
up.
Sam. Come here, Sam. Let's introduce our Mod Squad audience to Mr. Mehmeti. No?
Let's chill.
Sam is chilling. You
Let's,
know what? Sam actually helped us cut the mask
let's,
because he's such an amazing daddy.
Wasn't it? It was the cutest touch ever. And
Isn't
he
he so
cut him
sweet?
himself and
Look at
everything.
Lydia.
Yeah. Let's just roll to number 4.
Lydia,
number
can
3.
I have
Three,
that
number
ring?
3.
Everybody's
Your
husbands
ring
are
is
in
blinding me right now.
Hello. ADD. Let's focus on number 3.
Number 3.
Number 3. What's number 3, Graco?
It's cash out refinance.
Yes, to buy properties.
Yeah.
You know,
I
Nick, you and I are working on a deal like
I
that.
don't like number 3.
Why
but
not?
it's the literally the 3rd most popular reason people refinance.
Cash out refinance. I mean, I've had clients who everybody wants to flip properties these days. They want to become investors. And I actually had a mom, single mom who decided that she wanted to get into the game and she had to pull equity on her existing home because she was actually pretty smart. And in 2012, she was able to secure a 2-flat, which now appreciated so much. I think it was like 125%. Ridiculous. And so she was able to cash out and tap into that equity so that she's able to buy something else. And she was able to buy the product in cash and rehab it in cash so that she, so it's easier for her to buy something because you know that when you're buying in that assets category or just a property that needs work, you're going to leverage very well if you're buying cash.
We love when that story happens. That's the smart way to cash out. If you're going to go, possibly cash out of your equity to buy another property or, you're really committed to a business that you're about to open up, I guess going to your savings, that's what you save for. And essentially equity is savings. at the end of the day. That's yours when you sell the house, correct?
Correct.
I love it that you
But-
say that.
But at the end, it's a forced savings. We had a show a while ago where that's the only place that people are forced to save. Now, it's also like a loaded gun. You know, cash out refinance, the reason I'm not such a huge fan of using this as one of the reasons to refinance, it's a great tool for someone that wants to buy another property. They're going to open another business. Maybe you take it out of your existing home to buy a second home in full, pay it in full. I don't know. There's a lot of reasons to do it. But you have more times than none, most clients that we see that do a cash out refinance are leveraged in debt. And they're tapping the equity of their house now to pay off their credit cards, or they bought too many cars, or whatever the case is. Student loans you can't really get away from, so we understand that. It's just that the payment schedule for you is too high outside of your mortgage payment, and if you consolidate everything into a 30-year loan, everything becomes more manageable. And that's fine and dandy. That's the smart way to do it, because if you can't afford to make your monthly payments, everything starts going south, correct?
Correct.
However, it's incredibly scary that you're walking around now with open lines of credit of $40,000 or $50,000. Those credit cards are paid. You know, you don't have a car payment, so maybe you want to get a new one, a nicer one, and you just go trade this one in and take on a new small car payment. This is what happens. We see it happening over and over. I've been doing it 22 years where I've seen clients come back at me every 6 years, reliving their equity and recashing out their equity. And I'll do the loan because they need it and they want it and they can't afford to make their payments, but this wasn't what the equity of your house was designed for.
Well, and you have to wait. It depends on the time period, right? Because it was, when I first bought my 2-flat, I was able to cash out and pay off my student loans. And I know a lot of people will frown upon that, but it was a strategic move because I knew I had equity in the property and it was a rental property. So I was making money. I was earning money with the product. And eventually the property appraised out and it was able to, cover everything after it sold it. So you just have to be a bit strategic about it. Make sure that, the values are going up and that you're not just burying yourself in debt. But I like that you said that, property is a forced piggy bank or a savings plan. What is the difference between a line of credit versus just cashing out? And
It's still the same thing.
It's still the same thing?
There's a difference in the terminology and there's a difference in the mortgage rate and the structure of the loan. And most line of credits are based off of variable. Typically, you see them based off of prime versus 30-year fixed mortgages, or even any traditional first mortgages are based off of a 30-year amortization where they have at least a fixed period, if not fixed for the full 30 or 15 years. So you'll get a 30-year amortization loan where it's got a 7-year ARM where the rate's really low for the first 7 years, or a 10-year ARM, or a 5-year ARM, then eventually it'll adjust, but it's based off of 30 years. Home equity lines of credit are like credit cards attached to your house. That rate can move whenever. It follows the market trend. So most of them are, like I said, based off of prime. If we see a huge hike in prime over the next 2 years, your credit card rate, your mortgage credit card, which is also known as a HELOC, home equity line of credit, is going up with prime rate.
See,
for
and
the
that's
most
why
part.
you have to explain that because it gets really complicated even for myself. So when you're talking about doing a cash out refinance, your property is going to be appraised out at the level of the new cash out amount, correct? And you're going to have a new loan amount at the highest value. But then you can't, what if you get like a HELOC, you're able to use that money on and off, and then what if you don't use it at all?
Lenders still classify a HELOC, a home equity line of credit, as a cash out.
Okay, but
You don't, because it sounds different. It sounds
okay. So that's just your
interesting.
terminology.
It's a little bit more of a terminology. The reality is, if you have a plan, you're cashing out, and it's a lump sum of money that you need, and you know what you're going to do with that. So let's say, for example, I'm opening up a new restaurant.
Okay.
And this is my dream. This is what I was willing to spend my equity on. I know I need $50,000 to open up this restaurant. I don't have it in cash, but I have a little bit of cash, and I have a ton of equity. I would advise somebody to not take out a home equity line of credit with rates at a low rate that they currently are, because I know that home equity, most of them, the alluring ones, are based off of a variable. And it might take him a while to pay off that $50,000, right? Or it might not. But if he's committed to knowing that it's just 50, I know if I have this, I'm done, I'm good, that's whatever, then I would look at his first mortgage rate, see where that is. If it's a 4.5, 4.3, for example, and I'm just going to kind of linger today's rates out there for a minute, I'd say, okay, why don't we take the $50,000 and reduce the 4.3 down to 4, add it to your existing balance, but now the whole thing is lower. All your interest is lower, versus letting him go running off on a $50,000 mortgage, second mortgage that could turn into, today it might be at 4 or even 3.5 because prime is low. and then it rolls into like 6.7. He still can't pay it off yet.
And
Right.
those are typically interest-only loans, those
Yeah.
HELOCs. So
Yeah.
he's never paying down
Or
the
the
principal.
alternative where you have to get an investor who's going to charge you more on that money that you're borrowing, or someone who's going to be telling you what to do with the investment.
I like HELOCs for like smash and grab scenarios, like where you're gonna go do a quick investment, but then once you pay off that,
Did he
you're
say
gonna
smash and
grab?
grab?
yeah, you're just gonna go. You're gonna use the HELOC.
I
for,
kind of like his
you're
other
gonna, you're gonna use
terminologies
you're gonna,
then.
you're gonna use the HELOC. Well, you're gonna use it for a minute, and then you're gonna hurry up and go do your flip or whatever you need
Right.
it for. Once the flip was paid, you're gonna pay the HELOC off. Fine, that's great. That's what it's really designed for.
See, that's what I was
but it
getting
doesn't
to
happen.
because that's like the perfect scenario where you're able to make profit, build some profit on that flip, and then go back and put that money back in the home,
Yeah,
so
but
that
you were in
now.
an era that price values are just skyrocketing
Right.
every month.
Okay.
And that's not realistic today. So you put a millennial in a 2-flat today, they're getting 3 to 5%, if they're lucky, appreciation annually. You were getting 20% probably quarterly when you were
Yeah.
able to pay off your student loans. back
Right?
then.
Yeah. Yeah.
So you
And
can't.
I can't stress how, neighbors talk to one another, friends share opinions to one another, and everybody has, something that was great for them. Right. So if Mimi went and did a HELOC on her home because she was going to just do a quick flip, she needed $70,000, she's going to pay it off in a month. That's great for Mimi, But when you're going into a situation where you're contemplating a home equity line of credit or a quote unquote cash out loan, or do you do it all, or you should consult somebody because your situation is definitely different than your neighbors in one way or another. Maybe your rate requires you to refinance all of it in one lump sum, and that's the real way to do it. Maybe you have such a great mortgage rate on your first mortgage that it'll be a shame to touch it because those rates don't exist today. For example, there was a 30-year fix at one point floating around at 3.25 a few years back. I would be really hesitant to tell somebody you have to cash out all of this and put everything at a 4% or even a 3.8 today just so you can grab $20,000 more. That's just really bad financial planning. So you can't just say, that's what I want a HELOC. It doesn't work like that. It really doesn't.
And it has to be something you plan too. Even with like adjustable or anything like that, you have to be able to plan and sustain your credit and all those details about yourself in order
Sure.
to do that. So some people fall in a hole and then they can't get out of it, right? So
Right.
it's something you constantly have to be on top of.
And I'll tell you a funny story about a home equity line of credit, which is all lumped under the cash out refinance, by the way.
Right.
People in 06 were taking them out everywhere. There's just give me 300,000, just give me 200,000, and they always had this as a fallback plan in case something got rough. Well, in 2007 and in 2008, when the market started to slide, you saw a lot of lenders slash or even remove the home equity line of credit that was once approved for you. I know somebody that actually was going to build his business based off his home equity line of credit. He wrote a home equity line of credit check, didn't know it was cut until the check bounced, and he had plenty of equity there. Well, he thought he did. Or he thought because he had a home equity line of credit that it was good forever.
Right.
And that's not the case.
Right.
When they see that the house is devaluing, they might shrink it down on you, which is what happened to a lot of consumers back in 08. So a cash out refinance is it's something that needs to be thought out really well before you just do it.
Sorry, guys. I was doing.
It's okay. We have Lydia here.
We have Lydia.
She
Lydia,
closed
go
a lot
ahead.
more deals than you have over the
Yes,
years, right, Lydia?
overtime. Lydia, yes. Top producer Lydia with Remax. Sorry. I was trying to
Normally,
get-
Lydia, you talk a lot. Why are you so quiet today?
Lydia, you do have the sexiest voice. Now I know where
you normally
this
don't
weirdo
stop
gets
talking.
his little
But usually when Carla talks, I have to listen.
Oh, really?
And when Nick
Lydia.
talks about alone, I have to listen. Because
Wait, I sent
Wait.
Lydia a
He needs to find
request
it.
for like, hey Lydia, can you send me a photo of Nick so I can do this stuff?
What is
she
it?
sent me like 20 photos of Nick, like
Is this
seriously. And then she sent me like your cutouts of your baseball years or something. My son,
Right.
by the way.
Greatest, the greatest baseball player in the history of Lions
Wait,
Cook Little League right
Wait,
here.
I'm waiting to see the
I
Nick
even
shrine.
sent you the newspaper.
I've seen
Did
a
you
little
see
bit
the
of the Nick
newspaper?
Do you
shrine.
have a Nick shrine?
She has a Nick shrine, right, in your basement?
It's a 20 by 20 room.
It's quite sickening.
What
You
is
should
it?
have
Bring
had
your
more
parents
boys.
to work day? Jesus Christ.
It's your birthday.
Yeah, I think we're going to do the nitro question today on Nick.
Oh,
Are you doing it?
Oh, yes.
That's dirty.
Get it.
That's
Get
on.
Nick on the nitro question.
Okay,
let's-
everybody
let's get
position.
let's get you, Rock. You're going to give us number 2? Are we,
Yeah.
are we doing a nitro question right now?
Yeah, most embarrassing situation in your career. Most embarrassing situation.
We're ahead of the game here. We're ahead of the
Real estate,
game.
On the mortgage side, even on the modeling side.
Most
Wait,
embarrassing
let's
situation?
keep it professional, though.
No way.
Think about it. For
Think
a little
about
bit.
it.
Think about it for a little bit, and we're going to touch on number 2 right now.
Okay.
So to recap again, Nick said number 5 was to remove somebody from the mortgage note, whether it be for divorce or whether it be for removing maybe a parent or a co-borrower applicant that helped sign on the mortgage.
That's cute.
The second, or number 4, was get rid of mortgage insurance. Number 3, Nick touched on also cashing out refinancing, whether it be to reinvest or pay off debt. Number 2 is going to be shorter terms, refinancing your mortgage to lower the term of the note. So if you have a 30-year fixed mortgage and you're considering maybe going into a 20-year fix or even a 15-year mortgage, this is a good option, especially if you can lower the rate substantially. You're paying less interest in the life of the loan. So that's something to consider when refinancing.
But when you're doing that, you're also increasing your monthly payment.
In some cases, slightly. But imagine this. If you have a 5% 30-year fix and you're dropping down to a 3.8 15-year fix, you're probably not too far off.
It's not going to hurt that bad.
It's not going to hurt that bad. Even if it was $100, call it, it's still something that you should consider because you're knocking almost 15 years off that 30-year payment.
I like to call the 15-year fixed mortgage the Bentley of all mortgages. It's like literally, if you can afford to do one, and that's, going shorter term, that's the most common one we see. We see people that want to leave their 30-year. I still see some people coming in with their old 40-year loans, and they want to take a very tactical approach at paying off the house much faster. And that's smart because there's 2 reasons to pay a house off much faster. It's not just that you have your title in your hand in 15 years. It's also that they get far less interest from you than they would if they did a 30-year loan. It's more than half of what they would have gotten from you in total interest over the next 15 years. So a 15-year mortgage to me is the most common one that people pay their house down faster. Now, you don't have to do a 15 years. There's some clients that really are ahead of the game with their finances and they do a 10-year. Do the math. That's barely a car loan. I mean, there's 6-7-year car loans now, right? So there's people that are actually doing 10-year fixes. Again, the interest rate is lower the lower you go in the amount of time you're telling a lender you're going to pay it off. So there's an incentive there. And the amount of interest they can actually capitalize on you is substantially lower every 5 years you're clipping off of the existing mortgage rate. So, that is the most common way of doing it. If you can't afford a 15-year, there's always a 20-year fix, which is good loan.
You can always opt not to, right, and just send more money to your principal on a monthly basis, quarterly basis, annually basis, and you're paying off that mortgage a lot faster versus actually worrying about that hefty 15-year mortgage payment. So keep in mind that you can pay down a mortgage. Even if you're in a 30-year fixed mortgage today, realistically, you can pay that down a lot faster if you send more money to your principal.
But you're not getting the benefits of a 15-year where you said the interest rate might be lower,
Remember,
right?
This is a simple interest loan. So
Right.
you're not paying juice or interest on the life of the loan because if you're going to pay that off in 20 years because you sent additional money to the principal, you're still reaping the benefit of being in a 15-year mortgage or even a 20-year mortgage.
And you're also reaping the benefit of building your equity.
Well, you got to remember, when you're going shorter in term, you have to hit a double home run here. You can't, you can't just say, oh, take me out of my 30, put me into 15 years. It doesn't. What if you have a 4% on your 30 and the new 15-year fixed rates, let's say if rates go up higher, are, 5?
Nick, we don't quote rates. No, I'm kidding.
I'm just giving an example where it wouldn't necessarily. Then I would take Grocco's strategy of just paying down the mortgage with your own money and having self-discipline, not actually going into a mortgage lender to refinance the house. You want to do a 15-year fix where you're also capitalizing on the rate going lower from the existing rate you have. There's too many people that will say, oh, you know what? I've actually heard horrible salesmen convince somebody to leave a 5% 30-year fix and go into a 5.5 15-year fix. And look at the amount of interest you're saving in total. It's like they don't need to do a refinance for that. They could just accelerate payments on their existing 5%.
Yeah,
that's the key.
Why would they do that?
Well, there's still unscrupulous people out there. Now, I don't think you can get that passed in today's world, but it has happened. And you have to, generally speaking, you want to go down in interest rate when you're also, going down in a term. Right.
This gets really complicated, and I know a lot of people just buy and they get really enthused, and they're like, okay, as long as my monthly payment is X, but your payment's going to increase at some point because of taxes, property taxes. But for the most part, a 30-year fix is going to be a fixed rate for you. And if you want to know more about like a 5-year long term or a 5-year ARM, or you just have questions about your current loan product, take a picture of your bank of your mortgage statement, send it to us at info@marketoverdrive.com, and either Nick or Grok will be more than happy to review that with you guys, so they can give you more information on it. And of course, if you are looking to sell something or you want to buy something else, you may want to keep the property as an investment and go buy something else and just be able to refinance and keep it a really affordable interest rate. Now, guys, I know at the beginning of the year we did have that increase in interest rates. What are we seeing, or are we anticipating any increases in the upcoming year?
I think you should always be on red alert right now that at any given moment rates are going to go up because they're not planning to go lower. Okay, let me correct that. You might see rates improve next month. You might, okay, but that doesn't mean from a general forecast moving forward, everybody knows they're going to go up. The plan is for them to go up. Not quickly, but they're not. You're probably not going to see rates go to like 3%. That's just my opinion.
So make sure that you align yourself, as always, with an expert to advise you as to the best strategy for what you're trying to accomplish. And if in 2018 you're looking to buy or sell something, you may never know what strategy to take. So just talk to an expert who's going to be able to look at your mortgage statement, see how much the payoff amount is, and if it makes sense for you to either refinance or just cash out and enter the investor pool where you're buying and flipping properties with us.
A great time for people to start considering themselves into a 15-year mortgage if they're currently sitting at a 30 is usually when one of two things happen. We see them come into us the most common time, and they're asking about a lower term. Let's say you bought the house solo and then you got married. Now you have another income in your house. You have some disposable income. That's when they typically want to see what's the options of a 15-year fix because it's more affordable. Because it is a higher payment, generally speaking. Or B, you just got a raise, like a substantial one where you feel good about adding an extra few $100s a month. You're sitting at, let's say, 4% today. You can go to the 3.5 on a 15-year fix, and that extra $400 or $500 a month is not going to hurt you where you want to, pay the house off faster. That's great. Those are the most common times that people should probably pick up the phone and call a mortgage company is when one of those two things have just recently happened.
Last point on that, on why you should go shorter term. You're only doing this if this is your forever home, by the way. You're not refinancing a 30-year fixed mortgage into a 15-year mortgage if you're planning to sell this property in the next 5 years.
Probably not.
Okay,
No.
so keep that in mind. If this is a forever home and you want to, keep this long period, then it makes sense to send additional money to the principal monthly, quarterly, or annually.
You mean forever by not just being where you're going to live. It could also be an investment property that you're going to hold on to and cash out and cash flow every month, so you want it paid off.
Right.
It
That's
just makes
what you mean
it
by forever
right.
home.
It's for whatever people want to do. Because in my scenario, I cashed down and it was still building equity because the values were increasing. So it was a different time period, like you said. But if somebody's looking to become a landlord and they're assessing its worth by how much money they're making in rental income, and but of course your ultimate goal is always to have the better cap rate, which is pay off your mortgage and collect rental income and to have the property pay itself.
Number one.
Here we go. The most common one. It's very simple. The most common reason people call us to refinance a house, and the most common reason you should always check with the lender, is to just lower your payment. The bottom line is if you lower your payment, probably means that you have a little bit more cash flow every month and you're a little bit more comfortable. You could apply that money to other things other than your mortgage. We're obviously real estate centric here on the show. This is what we do. But if you save $400 a month just refinancing from a 30 to a 30, maybe you want to invest that in the stock market. Maybe you want to invest that in something else. Maybe you just want the pressure taken off. I mean, there's a lot of reasons why it's always great to lower your payments on all your bills. And it is still, to this day, the number one reason people call us. It's just to bring the payment down. That's it. In whatever way possible. It's still the number one reason.
So let's recap them from the top. Nick.
All right.
What are they?
Number 5 was to remove somebody from the existing loan. Not just the deed, not just the title, but from the existing loan on a property.
Number 4.
Number 4 is to get rid of the dreaded mortgage insurance. Am I busting? Typically, more cases than none, you got to have to refinance to do that.
Number 3.
Not a big fan of it, but it is popular. Cash out refinance.
Number 2.
Pay this bad boy off faster. Get rid of the mortgage overall. So just pay the house off even faster.
And number 1.
Plain and simple. I just need to pay my bills.
Lower your payment.
Lower your payments.
Lower
Make
your
everything
payments.
cheaper. You know, maybe you bought a house at 5%. Rates today are 4%. It's common sense. You're just giving away free money on interest at that point. Refinance it. Get yourself a lower payment. It's very simple.
And I say it all the time. I'm not kidding. Align yourself with an expert that's going to guide you through this process. And if you're working with the realtor from inception, when you buy your property, it's not the last time you're going to see them. Always stay in touch with them because you're going to need to get that closing statement when you're, filing for taxes. But more importantly, look at the tax exemptions. Find ways to reduce that mortgage payment by reviewing tax exemptions, making sure you're getting all the stuff that you can claim. Homeowners exemption. Maybe you're aging, getting older like Nick, and you're going to get a senior freeze. Make sure you can tap into that. And also talk to your insurance agent to see if they can revisit the quote for your insurance premium and reduce your monthly payment.
If I had feelings, they would be hurt.
But we
And
all
let's
know
get-
you don't.
Carla,
Yes? Oh,
if you need to refinance your
Yes?
home,
Okay.
please call iLoan.
Thanks,
Nick or
Lydia.
Graco.
Did you notice? I never
serious
I'm
and
never
everything.
afraid of anyone. Just like because Lydia's just like Carla, I'm like, yeah, what I do.
So
You
let-
don't have to be so
But it is
serious.
Well,
about
I
it.
just
to
want to
You don't fit
remind you
in.
that you must call iLoan.
All right. That's enough.
Because all the other lenders, what, Lydia?
But it is important to align yourself
I
with
learned
your
it's better.
realtor who has great relationships with a
She's
lender.
so tamed in the studio.
Wow.
She's
She
like,
is.
they all
It's all the bright
suck.
lights. It's all
Say
the
it,
bright
Lydia.
lights.
They all suck.
We gotta,
All right, we're cutting short on time,
we're
so
running really
All right.
short on time.
let's
Go
get this
ahead.
nitro question.
Because we got to go. We got
We got a plane to catch.
We got a
No,
plane
I'm
to catch.
sorry to get in between you and your social life.
Nitro
Oh, this is
question.
work. Most embarrassing moment
You call
in your
everything
career,
work.
whether it was real estate, the mortgage industry,
It was
or
it
whatever
was-
industry.
It was,
was
you know,
today.
I wouldn't say it was embarrassing.
was today.
This is kind of, this is bull that I got to do the nitro question. First of all, I'm the one that asks the nitro question.
Actually, the nitro question should
The
be for
producer
Mimi,
asked
but-
me to do it today because
Mimi had the nitro question already.
It wasn't, I think everybody knows I don't get embarrassed very easily, so it's not like I really even care if something funny happens. I think the most embarrassing thing to me was I was had, and it was like early in my career.
You were had.
What was that?
Yeah,
mean?
like somebody took advantage of me and I felt really stupid. And then I left the room and I think the other person knew that I was going to be taken advantage of in this particular scenario.
Someone took
Not
advantage
physically, you
of the
creep.
Maddie.
Like
I was 2 years in the business. I'm sorry. This was my second loan. I wasn't even two months in the business, and I just didn't know how to do a VA loan. And so I was working on a VA loan, and I was working underneath this loan officer above me that was helping me supposedly do it because I just don't have experience.
You
And
mean
so-
you had to work underneath someone? You weren't born awesome?
No, it took me at least 3 months before I became officially awesome. No.
It's all news to us. I mean,
So I'll never forget this prick.
no names.
No, his name's Larry from Equity Mortgage. He's a real piece of crap. Larry, pay back some bitch, bro.
Oh my God, your mom is here. What's your language?
Who's your daddy, bro?
Oh my gosh, this is terrible.
No, but he
Now he's running to Nick for a
he
job?
had me running. He had me running through hoops. I knew how to read the rate sheet. I knew the kind of money I was supposed to make, and I was supposed to make a few $1,000s on this loan. And it was a profitable loan, so VA loan, whatever the case is. And he had me running back to the client's house, back and forth. I mean, this is the 90s. Emails weren't really popular, right? And I worked my butt off, kind of didn't understand. And then when I went to go get my money, collect my check, he gave me $200.
Oh, wow.
And I was like, there's a lot more money in this than $200. I mean, I spent more than $200 in gas. And he basically said, yeah, well, you know what, kid, if you could do the loan on your own, you get paid more. And it was like really a humbling, and I just felt like I was completely taken advantage of, which I was. And I just kind of swore at him and called him about 1,001 names. And when I was walking out, I walked out of his office, one of the other loan officers just kind of smirked and like was, to me that was somewhat embarrassing. And I guess it fueled me and made me mad, but I don't get really embarrassed.
so
you know?
did you give him his $200 back?
No, I ended up opening up a big company and taking a lot of his employees one day down the road. And, but I'm not done with you, Larry. I'm still talking about you today. So,
Legendary. What's
I
that
got
go?
you.
Epic.
Larry, you
Yeah.
Always be legendary.
Always be what?
Legendary.
Are you making fun of me, Grappo?
Yeah,
Because
no,
I'm
we
trying
always
to be
make
cool.
fun of you.
Yeah,
We
let's.
gotta wrap this boy up, man.
wrap
This
it
is a
up.
long show.
It's been awesome. You just hate it because it's about you. Despite the fact that he talks a lot, you're actually a little humble.
How much time do we have left?
Like 2 seconds.
All right, we're done then.
No, we do have a caller. Somebody wanted to call in and wish Nick a happy birthday. More surprises for you,
Okay.
Nick. Just
Oh,
relax.
Lord, who is this?
Who dis?
Who it is?
What's
Shanika?
up, Nick? Handsome Nick. Mo, what's going on?
Oh,
He was just really upset.
I
He
heard-
said,
Is it Larry?
My seat still feels hot, Mo.
Does it?
What'd you do to my
All
seat
that
while you were
handsome heat
here?
I left off.
Oh, that handsome team.
Happy birthday, buddy.
Thanks, man. I appreciate it.
I love you, Mo. I know, right? He said he needed the extra
you guys,
balloons so he can fill that seat after you left.
Remember, wherever I am, even if I'm not here, I'm watching, Mo.
Whatever,
Don't
Mo.
take
I'm
advantage of my
watching
seat.
too.
Great job,
I'm trying
superstar.
not to get in a car accident.
I'm gonna need to get your
Watching you
autograph
guys.
now with your write-up on that race car. Did you guys know that he's a racer?
He is. He's got some really cool whips, too. Thanks for calling, Mo. I appreciate the wishes.
We love you,
No
Mo.
problem, guys.
See you
Happy
again next
birthday,
week.
Love
buddy.
you, Mo.
Okay,
Happy
guys.
birthday, Nick.
Yay.
We
And
wish you
Carla.
the best
Happy birthday,
always.
Nick. And Carla.
And
tomorrow.
Carla.
Carla, we're taking care of next time.
Yes.
Okay.
Carla's
Don't
gonna
worry.
be
If
taking
it's Nick's
care.
birthday, it's Carla's birthday because
It
Carla
is.
hijacks everything that Nick has.
Well, we got the cake.
True
We're not getting
story.
cake again for Carla tomorrow.
So-
It's
Yeah, I
today.
want some of this
Lydia,
cake because
I'm
we got to
getting
catch
my
a
own
flight.
cake.
Catch a flight. Let's wrap this bad boy up.
Sign
All
I
right.
off.
want to thank.
As always, thank you for watching and listening to us.
Wait,
what?
one more happy birthday.
What? Oh, yes.
Nicolas.
Yes. Oh, my gosh, for sure.
Oh,
Nicolas' birthday is tomorrow.
Happy birthday, Nico, our mod pro. Thank you so much for everything
Nicholas
you do
Lanos.
for producing Market Overdrive. We heart you. And this is going to go in the mail today because I thought you were going to see the boys this weekend and you're not. But I kind of went and got you a bunch of singles, you know, so you can buy candy.
And
Happy birthday, bro.
happy
Or
birthday,
Happy birthday,
egg
Nico.
candy.
Happy
Happy
birthday.
birthday, Nico.
Happy birthday, everyone.
That's
Nick,
it. We're gonna wrap this bad boy up. I want to
Come on,
thank
Sam.
my co-host Carla Mina for
We have a
setting
live
up this
audience today.
strange extravaganza. I mean, there's a time to cut me off. And there's a time to not cut me off. But let's just do it. I want
Look
to thank
at
all,
that. Say hi
of
to
course, the
everybody.
real estate diva herself. I mean, am I gonna wrap this thing up? Or are we gonna
Wrap
Go ahead, wrap it up. Just
We're
let her
gonna-
do
the
her
real estate
thing.
diva herself for coming in today. I mean Luna, Grago Funas of Ilone, and of course my mama for being here on my birthday, Lydia Mametti.
Lydia
Remix.
Mametti.
Thank you, Nick. We
Catch-
love
Mametti
you.
You can
family.
catch this show obviously on WGN Radio Plus podcast. Subscribe to it or go to YouTube or Facebook/Market Overdrive. I'm out. We'll see you next week.
Happy birthday, Nick.
Happy birthday.
It's a live audience today.
That's gonna be one garbage seller of words.